One of the things I think is really difficult for property investors is bringing the theory and then putting it into practice. Because we always talk about the bigger picture of what we should be looking for in a property, in terms of having owner-occupier appeal rather than investor-only appeal. We talk about it needing to be investment grade, typically between $300,000 and $850,000. There are variations to that, but that's the typical investment grade sweet spot. And then the third part is it's got to have some form of scarcity, which will help drive the underlying value. So that's a really great framework to start. But how do people then overlay that to walking at street level and being able to apply it to the anxiety and the adrenaline that comes from when they've got to put their name on a title and actually buy something? So I always think there's 4 things that you need to consider. And I think it's best illustrated by talking about an example recently where I was looking to buy a property for a client that stacked up. It had scarcity, had owner-occupier appeal, it was in the investment grade sweet spot, so tick, tick, tick. But then when I saw the property, I had to really drill down a bit further. And so capital growth-wise, I back-tested its performance and it actually stacked up, which was really, really good. The second thing I need to think about is cash flow. At the end of the day, we need to be able to afford the property, and I need to, as a product of rental yield, I need to know how much income I'm going to get and how much it's going to cost me at the end of the bottom line. So again, it's stacked up in those 2 things. And then the third thing was, okay, if I'm buying in a property that's investment grade, scarcity, all those sorts of things, I need to make sure I've got a tenant. And so if I'm buying in a suburb with really low vacancy rates, that's really good because I've got a really good chance of getting a tenant and it's going to be in strong demand versus the alternative. But ultimately, I looked at this property, vacancy rates were low, capital growth performance was really great, and the cash flow was really, no problems at all. But I was having this niggle. And the niggle was really, really all about one thing: the quality of tenant. My view on what sort of tenant was likely to end up in that property. Because it was a single fronted period home, which most people love. But down the road, there was a student accommodation building that had just been built. No one was in it yet, but it wouldn't be long before it was streaming with nightlife and studying and people coming in and out and all of the lifestyle that comes from having that student cycle of life. And my view was simply this: I think that was going to affect the quality of the tenant. Because if some professional was to look at this property and think, this is really great, but they look at that building and go, not sure this is where I am in my stage of life, I'm not sure this is for me because of that, I think that would really severely impact the quality of tenant that I'd likely to get in this property. And maybe if I couldn't attract those tenants that I'm after, I might actually only get more students or someone who isn't going to look after the property as well or is happy to tolerate that. So ultimately it failed that test because capital growth was fine, cash flow as a product of rental yield was fine, the vacancy in the area was no problem, but that last one, quality of tenant, was something that I was a little bit concerned about. So ultimately that's how I put these frameworks into practice when I'm out in the field. So if anyone's thinking about those 4 things, they can get some help because a buyer's agent will help you actually stack up the capital growth potential. If you've got an investment savvy mortgage broker or even a financial planner who's helping you cash flow your money through your household, they'll be able to help you find out what that shortfall needs to look like. And the last 2 in terms of quality of tenant and the vacancy rates, a really good property manager is going to help you with that. Because they're going to know, hey, if I put a for lease sign out the front, that'll probably go in 3 or 4 days versus 3 or 4 weeks. But they're also going to tell you critically what type of tenant is likely to live in that property, all things considered. So they're going to be a really great source of intel for you. So there you have it. When you're in the field looking to buy an investment property, you can overlay these investment criteria at the beginning, but you're going to have to make a decision. And hopefully those 4 things will help you make a better decision next time when you go to choose an investment property yourself.